Hello and welcome to BQ Prime. It's policy day tomorrow. All 40 economists polled by Bloomberg this time around expect a status quo. However, there are still a lot of things that remain to be seen. I'm joined by Radhika Rao, senior economist at DBS Bank, to share her views and expectations from tomorrow's policy. Hi, Radhika. Thank you so much for taking time out.
Hi, Bali. Pleasure to be here. Thank you so much.
I think I'll assume that you're also going with the expectation of a status quo in tomorrow's policy. But what I do want to know is what are your expectations on the liquidity front, for instance, and given the RBI stance of withdrawal of accommodation so far, what does it mean at this juncture? So that's my first question.
Certainly, I think, like you rightly mentioned, I think there's a complete consensus on what the central bank is going to do, which is to keep rates unchanged. And I think they've already surprised us last month, and the last review, and I think that's that whole path is going to continue. The bigger question mark is on the stance, and stance is basically, like you mentioned, withdrawal of accommodation. What would they do at this point? To our mind, I think. There's going to be unanimity amongst the committee on the decision, but not so much on the stance, because there are a couple of doves in the committee who would like a shift in the stance to more neutral in a way that you're basically essentially closing the door on further rate tightening. Our take is that the central bank would prefer to keep the stance unchanged, which is that withdrawal of accommodation. And the reasoning behind that would be that, even at the last meeting, even in the intermeeting comments, what we glean from the rhetoric is that while inflation is quite low, particularly this quarter, the central bank is wary about the path ahead, at least in the next couple of quarters. There are uncertainties on the outlook, especially on food prices and some of the weather and inclement weather. So because of that, they would like to keep, I think, the option to react if required. That said, after the April review, we do think that the bar for further rate hikes is still quite high. But I think what they would perhaps signal with their stance is that they are prepared to react if required. And these are all, of course, domestic factors, and exogenous is that, what the Fed is likely to do. What the Fed does is important for the RBI, but I think still is domestic considerations that will reign high. And going back to the the Fed, they've got, the inflation that is, it's come off highs, but month-on-month increase is still quite firm. Labor market is still quite tight. And there are other indicators which are suggesting that there is a risk of further move from them. So coming back to the RBI, I would think that withdrawal of the stance is basically going to be held and changed. And perhaps next meeting, they would consider a move down to neutral.
Oh, all right. And what does one make of the liquidity situation at this point? Liquidity has been fairly volatile the last few weeks. Currently, it's fairly in excess of 2 trillion rupees. What is the language one should look out for, or any guidance that the central bank might provide on liquidity?
Certainly, besides the stance, I think liquidity is another point of discussion. And if you dial back to before the pandemic, 2018, 2019, the banking system liquidity was near neutral. Into the pandemic, obviously, you wanted to avoid credit crunch. The central bank also intervened. All of that added. Because of the dollar sulfate, and what you saw is the liquidity actually was strongly in surplus. Now that we're coming out of the pandemic situation and things are normalizing, I think the intention of the central bank is also to bring down the liquidity position or liquidity surplus balance, and rightfully that has happened because of frictional as well as durable factors. And at this point, we would think that the emphasis of the central bank would be to keep it near neutral to slight surplus situation only. Right now, to the very near term, what do we expect from them to say tomorrow? I would think that they would re-emphasize what they've been saying for the past few meetings, that it's going to be a fine-tuning exercise. When there is a shortfall, they would step in. When there is an excess, they will absorb. And in fact, you can just see the action in the past 1 month. When there was a deficit situation, cash money, call money rates were surging, there was liquidity being pumped in. And this week, we did see that actually liquidity surplus has grown because of the banknotes high note cancellation that happened, and they are back again to do some VRRR, so reverse repo options. In fact, the central bank has shown this. More short-term ones, 3-day, 4-day, rather than the usual operational tool of 14 days. I think that's because the take-up among banks has also not been that strong. So I think they're preferring to just absorb for the very short term. So again, back at the meeting, what would they say? We would think that the emphasis very much would be on fine-tuning, being more reactive, watch developments quite closely. But I don't think they are going to sway either way in signaling what they prefer. At this point, which is back to very strong surplus. I think that part of the curve is gone. We are going to be either in flat, neutral, or a very small surplus balance for the next few months.
So, as you mentioned, there has been some skepticism among larger banks to absorb liquidity. What do you think? Do you think the RBI will need to tweak its instruments to kind of handle the situation at this juncture?
Money supply or liquidity for one is a function of various factors, right? There is a huge seasonality factor to it. At some point, currency in circulation, you see government spending twist as well as the RBI's intervention tends to infuse or absorb cash from the system. So that part is the one that is, which is not basically under the control or impacted directly by the central bank. So I would think that the emphasis would again be on money market operations, on liquidity management and through administrative measures. We don't think again that there's going to be any durable tool which is likely to be used. I think they're going to emphasize that in May, the situation, the balance that was there, it was addressed because government spending had been picked up. Currency in circulation had eased, and the intervention, had also helped balance this entire liquidity function. So I don't think you would hear anything about their preferred stance. I think they are cognizant of the fact that the markets are looking for some signal, but I think they're going to maintain that they will let market operations continue as it usually does, especially on the seasonality front. They will only step in when things become adverse in either direction. So too much of a balance or too little. That's where their bias would be.
Sure. All right. Do you also expect any revisions to the inflation forecast? Possibly a downward revision considering the Q1 forecast and our performance so far in the ongoing quarter?
If you see the central bank's forecast for inflation, it's at about 5.2% for the year we are in. That's fiscal 24. I think what we could see could be a very modest downward adjustment. It's at 5.2% current forecast. It could be brought down to 5%. And the justification behind that would be that the first quarter of fiscal 24, inflation, the evolving inflation average is at least 60 basis points lower than where they had expected. They had pegged it at 5.1. Our own forecast suggests it would be closer to 4.5, 4.6% on average, April to June. So I think they could take that, factor it into their path ahead, and bring down the inflation forecast. I would be skeptical about expectations of a deeper cut in their inflation forecast, merely because if you hear their comments, they are still quite wary on inflation and inflation factors that would drive up price pressures this year, the risks on the horizon, and because of that, they would like to keep factor those uncertainties in and keep their inflation forecast at closer to 5%. So they don't want to bring it down to say 4.5 and then having seen risks again raise it. So small adjustment likely just because of the first quarter undershoot. I would think that might occur. If not, I don't expect a deeper cut in their inflation forecast.
Would it be fair to say that it's too soon to expect any changes to GDP growth forecast?
GDP focus, that's the interesting bit, and I think the fourth quarter fiscal 23 numbers certainly did surprise us as much as it did the consensus expectations. Especially on the GVA front, we had seen many of the engines firing at the same time. It's a very encouraging start to the year. Going into fiscal 24, I think they expect growth to be at 6.5%. Our own number is a bit more conservative than that. I wouldn't think that they would go ahead and even raise that some more. I think they flag balance risks on growth front. There could be some undershoot because of what's happening globally. And there is likely that the momentum domestically will stay strong. But at this point, I think deviating too much for 6.5% might not be preferred. So, while maintaining their belief that the growth path is quite resilient, they would maintain at 6.5%.
So, a couple of follow-up questions on that. You did touch upon inclement weather as a foreseeable risk going forward, and I know here again it is a little bit too early to be able to say anything on the monsoon front, except that the fact that we have seen a delay in the onset of the southwest monsoons. So far, the view is that as things stand today, it is unlikely to have any impact on Kharif sowing or rural incomes, but it remains to be seen going forward how the southwest monsoons do pan out. So, how are you viewing the situation?
At this point of the year, usually the monsoon and the impact thereof on agricultural production becomes certainly a huge point of discussion. And while we do speak of monsoon, I think between crops as well, the kind of weather that holds also is important because it has impact on the soil moisture as well as on the reservoir levels, right? At this point, the reservoir levels are actually better than the 10-year average, though there are significant interstate differences. Now, going back to your question, I think one of the key developments that many of the authorities are watching for, and of course, India is watching is as much as some of the ASEAN countries as well. In fact, there was one official from one of the ASEAN countries saying yesterday that they see an 80% risk that there could be an El Nino onset. Now, those risks, I think, is very important to watch. Whenever El Nino has occurred, it is not to say that we have had a drought. That's probably about 55, 60, only 60% of the time that has happened. But nonetheless, it does bring in, hotter weather along with it, as well as quite a bit of fluctuation, volatility in the rainfall. And as every season, it is not enough to just see how the monsoon pans out on aggregate. It could be above normal, but what happens within that season again becomes important as well. Is it equal everywhere? Are there significant shortfalls in some parts of the country? And if there is a significant shortfall, which are the crops that are grown then? So there are many questions as we head into the southwest monsoon. Like you rightly mentioned, there has been a bit of a delay in the onset. If it does say come in as early as next week or the week after, that would certainly be a good start. Again, it needs to stay strong. It needs to be as equal as possible across the region. So, and the implication-wise, southwest monsoon certainly impacts farm production, which in fact does play a hand in even our growth numbers. For example, GVA, if you see the agricultural, fisheries and forestry, 50% of that output is GVA crops alone, right? It has a very high correlation to the food grain output, for example. So putting all these things together, I think a weaker, unequal rainfall is certainly a concern, and its impact on macro variables, starting with growth, starting with rural incomes, fiscal need for administrative measures and higher imports, which are in turn have an impact on the current account dynamics as well. So certainly, I think that risk is key to watch. From the central bank's perspective, I think it would be important to see the fallout on inflation, particularly on food grain. Rice prices are still inching up. Wheat has kind of come off because of some measures that were taken. But if you have to look at vegetables as well, which is routinely extremely volatile. So certainly a risk to watch out for. I think implications are wide, but it does depend on the bigger formation of unfavorable weather as well as what happens to our own rainfall during the crucial month.
Okay, and one last question. What is your reading of other high-frequency indicators in the economy? Have they continued to maintain the momentum that we saw from the Q4 GDP figures? Do you think data is a little bit more uneven, patchy maybe, or do you think it remains as resilient as it did some of the quarters last year?
The few initial numbers that have come out, I think, are still holding up. And some of the high frequency numbers that we watch, for example, if I were to look at the labor markets, the labor participation rate, at least according to the private sector survey that we follow, the labor participation rate is up, and which in a way tells you that perhaps there is some optimism that employment conditions generally have improved, so more people are back looking for jobs. That has taken the unemployment rate up by a bit, but not too much. And if you see, for example, non-farm rural, which we take Manrega as a proxy, there as well we are above, we're off pandemic highs. Seasonally, April-May tends to be a bit high because of how labor demand is for sowing, but otherwise it's off highs. That means the non-farm rural sector conditions have also improved. And the formal sector, if you look at the EPFO contributions, if you look at some of the private sector surveys, especially Naukri, JobSpeak, those kind of things, it's telling you that it is holding up okay. Apart from that, are the activity indicators. Look at PMI, like the one for the latest number for services especially was incredibly strong, 60 and above. If you look at auto sales, and if you look at diesel, power consumption, there is of course an entire string of it, but all of that is showing into April that the momentum is still holding up. I don't think it's flying away, but certainly normalizing and holding up. The one thing that we would look for during the course of the year is services versus goods, and that's something we're seeing globally as well, that manufacturing sectors are not doing incredibly well, but the service sectors are. And I think domestically as well, we will tend to see this deviation where manufacturing conditions might not be, short-term manufacturing conditions might moderate, but the service sector will be the one which will fare better during the course of the year. So to come back to your question on high frequency numbers, as of April, we do think the momentum is still quite strong.
All right. As of April, momentum holding up, even if not flying away. That's my takeaway from that question. But all right. Thank you so much for taking time out.
Thanks, Pallavi. Thank you for your time.